So you already work for a startup or you're considering signing with one and you want to learn about stock options and the different comp packages. Yeah, that's awesome. Congrats. I hope it all works out for you. We'll be discussing the 5 most important things that you need to be financially aware of to help you navigate these waters. Let's get to work. Hey, what's up guys? I'm Kay Scholl. Welcome to another financial awareness video. If you're trying to make better financial decisions, grow your wealth and financial literacy, then you're in the right spot. Regarding employee stock options, there is a different discussion between private companies and startups versus publicly traded companies that are already established. Today we'll be focusing on private companies and these 5 important things you need to be aware of as you think through your decisions. What are ESOs? What are some different compensation package examples? How do they work? How can you exercise them, and when should you exercise them? Employee stock options, or ESOs, are quite simply a form of compensation, and they're typically given by the founder or a select group of investors to the employees of the company. This usually happens during an investor round of funding, and a pool of shares is specifically reserved for all of the employees. This creates a mutual goal and puts everyone on the same page to help run the company more efficiently, grow its revenue, gain more market share, so that everyone's stock options are more valuable down the road. Just imagine how a rising tide lifts all boats. However, instead of being given actual shares of the company, you are issued derivative options instead, and these usually come in the form of call options. This is an actual legal document, a contract that you sign, so it's legit. The document will specifically outline the number of shares you have rights to and at a preset price. The strike price. The total number of shares a company will issue varies with each company, and the total number of shares you have rights to may depend on your seniority within the company, the special skill sets and assets you bring to the table, and the compensation package you choose when hopping on the bus. The other reason why this is done for your benefit is because if the founder or investors just gave you the stock, that would trigger an immediate taxable consequence where you would have to pay taxes on the dollar value of the shares you receive, and you can't even sell your shares until the company goes public, which might not even happen. So that's why you're issued stock options instead of actual shares of the company. So what are a few examples of different comp packages? Obviously, I think this goes without needing to be said, but just to be clear, incomes range across the country based on your industry, your skill set, and geographical location, among just a few. Please just know these are examples and not true across the board for all startups. Additionally, if a startup is in its early stages, it's very likely that the salary offerings are going to be lower, with stock options being higher. And then there's a natural slope as the company matures, gains more funding and more revenue, that the salary offerings will be higher and the stock options will be lower. At some point during the interview process, if you get far enough along to be presented an offer, it may look a little something like this. Option number 1, $85,000 a year with 5,000 stock options. Option number 2, $75,000 a year with 10,000 stock options. Or option number 3, $65,000 a year with 20,000 stock options. Keep this in the back of your mind though. What are you signaling to your new employer, the founder of the company, if you take one of those options that has the highest salary and no stock options? Conversely, what is it saying about you if you take the lowest salary and the highest amount of stock options? Food for thought.
Psst, quick side note. It's probably way easier for you to get pay raises than it is for you to get more stock options.
Deciding which package is best for you is incredibly personal and will be different for each person. Here are a few scenarios. If you were blessed to have your parents financially support you during college and you graduated with no debt, or you paid your way through school and busted your butt and you have no debt, then you maybe could afford to take the risk of the lower salary and the higher stock options. Conversely, if you have a lot of debt or if you have a lot of financial obligations and a dedicated financial plan to accomplish that goal, you might be forcing yourself to take a higher salary and no stock options or lower stock options in order for you to hit your personal financial goal. In either case, make sure that you review your budget to make sure you know how much you need to make as you take on this new job. Link in the description down below for how to make a budget. So how do these things work? First and foremost, you need to be aware of what your strike price is. This is the preset price of your stock options noted in your comp package. Set your expectations accordingly though, because the price and value of your stock options are worth less than the paper they're printed on until you're vested and there is a major event that happens within the company. The three major events within a company would be an acquisition or merger, your company gets sold, or there's an initial public offering and your company goes public. Quick side note, the percentage of ownership you have as an individual employee is nowhere near as important as the number of shares you have rights to. So what about vesting? Vesting with ESOs works very similar to 401k employer profit sharing and employer matches. And if you want to learn more about those retirement accounts, click this link right here. The most common type of vesting schedule for ESOs is spread out over 4 years where you get 25% more vested every year, and usually there's no vesting at all for the first 12 months, but that's pretty common with most 401k and other employer plans as well. And they usually have an expiration date of 10 years, and if you leave the company 1 to 3 months from your termination date. How do you exercise your stock options? There are 3 common ways of how to do this. First, if you actually have the cash on hand to purchase at the preset strike price, then you simply just make the purchase and you hold on to the stock options until you're ready to sell. For example, if you have 20,000 shares and the strike price is 36 cents per share, then you would have to spend $7,200 plus any transaction fees. However, if the strike price is $1.36, then you would have to spend $27,200 just to buy your stock options. The benefit of doing this is you would then own the shares outright instead of having options to buy the shares, and you would become a shareholder of the company. Depending on how open and transparent your startup is, you might be entitled to a little bit more information as an actual shareholder of the company. Most transparent companies, though, will have a lot of information, maybe even more information given to their employees, but you never know. Shareholder meetings could have some nice nuggets of information in there as well. FYI, I mentioned a moment ago the 1 to 3 month expiration if you were to leave the company, so let me clarify that real quick. If you are not vested at all and you leave the company, you don't get jack, bro. But if you are partially vested or fully vested in your stock options and you leave the company, you have anywhere from 1 to 3 months to decide to exercise your stock options. But be aware, if you do, you have to front all that cash out of pocket to do so. The most common method of exercising your stock options is called the exercise and sell transaction. And this is exactly what it sounds like. You exercise your options and sell them in the exact transaction. The benefit here in doing this is that the brokerage firm assisting in this transaction will actually front the cash for you to purchase your options and then will sell them for you basically in the same transaction. And after taking their transaction fees, they will distribute the proceeds difference to you. Not as common, but still possible, is the exercise and sell to cover transaction. This would be exercising and buying only enough shares to cover the cost of the transaction and the cost of the shares. The benefit here is that you'll own the shares outright and can hold on to them until you're ready to sell. When should you exercise your stock options? Similar to how personal of a decision your comp package was, people exercise and sell their stock options for personal reasons as well, depending on what their goals are in their financial plan at that time. Given all of that though, it would be wise to wait until the company goes public before exercising your stock options. Doesn't really make a ton of sense to exercise them unless there is another major event within the company like I mentioned a moment ago. Here is a very simple and watered down example of when it would make sense to exercise your stock options. Let's say your strike price is $2 and the current share price is $5 and you own 10,000 shares. The most common way of doing this is through the exercise and sell transaction because you won't have any cash that you'll have to front in order to exercise your options. So you would not have to shell out the $20,000 in order to purchase your options, and you would only be paid out the proceeds difference of $30,000 minus the transaction costs that the brokerage firm is going to take. However, if your strike price is $2 a share and the current share price is $1.50 a share, well, then it makes no sense to exercise your options. Stick with me here because we have to talk taxes real quick. There are incentivized stock options and non-qualified stock options. Today we're focusing on non-qualified stock options because that's probably likely what you have. The moment you complete your exercise and sell transaction, you will need to allocate some of the proceeds for taxes. Because you did not hold on to your shares for more than 12 months, you will owe short-term capital gains tax, which is equal to your federal income tax rate. Alternatively, if you had the financial means to exercise your ESOs and purchase them with cash out of pocket, and you sat on them and didn't sell them for at least 12 months, then you would owe only 15% long-term capital gains tax, assuming married filing jointly, your household income is $496,000 or less, or if you're single, $441,000 or less. If you are about to sign with a startup, here are a few thoughts. Ask yourself if you will personally grow and benefit by being proud of the team you're joining and what you'll be accomplishing together. Know your minimum number of how much you need to earn in salary so that you can maximize the amount of stock options available to you. Keep in mind, it's probably easier to work really hard and ask for a raise than it is to ask for more stock options. Make sure you know what range of salary you are willing to accept during your compensation negotiations. Consider the whole package, not just the salary. If you're joining an early stage startup, see if your salary can be increased as the company secures new funding. If you've learned even one thing in this video, do me a favor, hit that like button and text it to a friend. Thanks for watching. Appreciate your time. If you have any questions for me, leave them in the comments down below. Thanks.